Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie. Let's take a look at the midweek market update. I'm going to start with the usual inflation discussion. And rubber may meet the road here in the next couple months, over the next couple Fed meetings, should inflation not decline quick enough, which may require additional rate hikes beyond the current expectation of around 5% at the ceiling. Now, Truflation, which is more of a real-time measure of inflation, has continued declining, but it has been doing so at a slower pace here. So if inflation continues to hold at around 5% over the next couple months, that may give the Fed additional ammo to continue raising, which will certainly disrupt the party that risk markets are currently enjoying, have enjoyed really since the beginning of the year. We did have some additional DXY weakness this week, thanks to this relative value of the likelihood that the Eurozone needs to continue raising while the US is sort of downshifting their raising. And we did see that play out, and we have seen that play out really since the beginning of the year, slightly prior to the beginning of the year. DXY continues to decline now below 102 based on the possibility of bearish trend according to the weekly cloud, as well as previous bearish trends for the DXY from around 103 to around 89. This would very likely give risk markets, specifically crypto, which enjoyed bull markets in 2017, 2020, 2021, additional tailwinds, momentum to move higher. Still enough to stem that situation, but it does look pretty good and convincing so far, even with the dollar declining. Now, it's probably not going to go straight down. Nothing ever does on a relative value basis. Most of this is the euro, but this trend continues to mean revert and correct itself based on, the U.S. economic health relative to the rest of the world, which very likely needs to continue raising rates elsewhere. Now, the S&P continues to flirt with 4,000 plus, continues to flirt with the diagonal line, which is always funny to see grown men arguing about over on Twitter, but this is log scale, and I've always used log scale. I like log scale best when I'm looking at things like this. Completely arbitrary and subjective, but as much as a bull as I want to be, still not yet seeing convincing evidence that this trend line has been broken just yet. I do like that there's the potential for this triple bottom mess of an inverted head and shoulders. You may be even able to argue a diamond bottom. Neither of those suggest bearish continuation. So if you're bearish here, what you do want to see is lower lows. If you're bullish, you want to see higher highs. Not much of a secret here. Higher highs in this case would definitely be anything above 4,000. Anything above 4,100, really, the previous high there, would probably be convincing enough. Now, are we likely to see that before the meeting next week? Probably not. But at the same time, if earnings come out better than expected, and if the hike is indeed priced in, maybe we do. We're sort of on the edge of both sides of the argument here, but it certainly looks like an S&P breakout trend-wise is being attempted, and this is the sixth time, 1, 2, 3, 4, 5, 6 times now, trying to break this trend line. Typically, when price knocks on a level over and over again, it does tend to break that level. So we'll see, but this does look ready to flip towards the bullish side of things here, and that would bode well for digital assets, obviously. Looking on chain now for Bitcoin, we look at transactions and active addresses here. And really over the past year, especially, we've been in a tight range here, but over the past 2 years, not much on chain has really happened. So we did see a decline on chain in activity after the Chinese clamped down on crypto. You can see this is likely miner related because it happened around the same time the Chinese miners moved to the United States and elsewhere. And ever since then, we've had sort of a baseline where we're not seeing these year-over-year increases anymore. But that may return once again if price action kicks up. We have seen increases in on-chain activity following price action. Very rarely do we see a divergence there. We did in 2018, but that's very rare. So as much as I want to say utility is leading price here, not really the case. We are seeing a slight uptick, but not by much. Bitcoin's hash rate, though, is reaching all-time highs again. This is a measure of the computing power of the chain trying to solve for that block reward. This is a monthly average. daily average, you can see things get fuzzy. It is kind of a fuzzy guess where exactly hash rate is at any given time, but we are starting to push higher here. You're seeing price support miners coming back online. You're seeing more and more efficient miners being deployed. You're seeing stories out of the US, for example. We saw the Susquehanna, Pennsylvania nuclear facility announcing completion of a mining center where they're going to use that to essentially keep the nuclear plant up and running, as it takes time to shut those things on and off. And using the power for something allows that plant to stay online. So hash rate is starting to get more and more agnostic of price. We're seeing gas flaring initiatives. We're seeing stories out of various geological locations where it's advantageous to mine crypto, to mine Bitcoin based on electricity in that specific region. So hash rate may very likely could just continue to creep higher and higher and higher over time because of those new utilizations for the network. They don't necessarily care about the Bitcoin network, but they do like the idea of being able to sell Bitcoin, converting energy to dollars, basically, where that's appropriate to do so. And if we look at the supply, we're seeing a lot of holding activity. This is the supply last active over a year ago, 1+ years ago. So around 44% of the network was active, has been active over the past year. That means roughly 56% of it hasn't been active, has been stagnant, and there isn't a rush to exit positions here or rush to exit investments here based on activity. During bull markets, you do see holder activity drop, especially towards the end. And we're not seeing that yet. We're still basically flat on holder activity. If we look at miner net position, again, this is, are they holding Bitcoin or are they selling Bitcoin? And on a monthly average, they have been holding on to more than they are selling. And you can see how that selling sort of reached a crescendo on a monthly average towards the bottom there. So in general, this is very much as you'd expect. If supply gets released at a greater clip, price takes a hit if there aren't buyers to step in, right? Now we saw a very large miner sell a significant position in 2021, and that barely dented price at that time because there were buyers to step in, right? But on the tail end of a bear market, which we are likely in, there weren't a lot of buyers at that time, especially post FTX, to sort of support price. So I would very much rather see this picture of miners selling into strength than sort of pushing the price down by selling into weakness. And then if we look at another type of supply metric, if we look at the market cap against the realized value of coins, which means we take a look at the average price for all the coins the last time they were moved on chain. Historically, when the market cap is well above when coins were last moved, you can sort of think of that as unrealized profit. That has marked the top. And the inverse is true when realized value exceeds market cap. So we're currently coming out of that nadir, as we have many times before in 2012 and 2015, 2019, even during the COVID low in March 2020. So for the on-chain enthusiasts, they very much like to see this because that signals that we've rinsed and washed all of not only the leverage, but the unrealized profit from any coins that have moved and are now starting this cycle fresh once again. And looking at BTC and ETH now on exchanges, that is sort of flattened out. ETH slightly up here over the past month, let's say. But again, you're not seeing this behavior of coins just being sent at large clips to exchanges. People can't wait to sell at these prices. That is not the case based on this read of what I'm seeing on chain. So it tells me if I think this is a bullish trend reversal, it's still early. Behavior says it's still early based on coin movements. And we've certainly got a ways to go based on previous, on-chain data and activity. Looking at ETH's on-chain activity now, transaction counts, active addresses, down slightly week over week, month over month, still well within the range, well within the previous all-time high. Again, the difference between ETH today and ETH in 2018 is there's plenty of DeFi activity, there's NFT activity. Now has all that sort of quieted down a little bit, month over month, definitely. Peak NFT was probably a year ago, and all that has quieted way down. Certainly NFT trading activity quieted way down. And that's going to show up here on the on-chain data because most of that happens on-chain. ETH also has layer 2 alternatives now. similar to Bitcoin and the Lightning Network. ETH is slightly in competition, just as Bitcoin is with the Lightning Network, on where those transactions go. And that affects this kind of data, where it may be cheaper to send those transactions in layer 2, it may be quicker, it may be easier. There may be some drawbacks to using layer 2 versus layer 1 or ETH Bitcoin. But the more popular those layer 2 avenues get, the more this layer 1 activity will likely decline because it has to, go somewhere else, right? So this is continuing to evolve over time as far as where transactions go, where can they go, what are fees on the chain. So my initial read of this is, of course, we're declining and not rising. We're not even flat. That may be more bearish than expected. But taking the layer 2 transactions into consideration definitely adjusts my attitude towards this decline here. There are still plenty of transactions happening on ETH regardless of layer 2 there. And if we look at the average transaction fee subtle here, it's rising from around $2 to $4. That's USD, but it does mean activity is coming back slowly but surely, right? Whether it's DeFi, whether it's NFTs, zooming way out, you can see just how crazy the fees got in 2021, 2022, average fees exceeding $50 pretty consistently. And now that layer 2 avenues are more robust, we may never see fees that high again on ETH because the network operates differently. It's not proof of work now. And there are other places to go and transact on ETH. There are bridging, multi-chain avenues. There's tons of other ways you can transact now besides just vanilla ETH. So from a user perspective, that's excellent. For maybe an ETH valuation perspective, that may change things over time. But focusing again on these slight rise, we're talking about a 2x in fees on average from the end of last year to now. Certainly rather see that than fees declining. And something else that's starting to pick back up is total value locked. Some of this is based on price appreciation, obviously. But total value locked in the DeFi ecosystem, rising ever so slightly from 40 billion to 47 over the past month. And you can see down here, 1 month column, yield plays picking up, liquid staking picking up, DEX is picking up a bit, stable coins picking up a bit. So much of the ecosystem is sharing this bounty in rising TVL. And ETH is slightly more and more deflationary every day. I mean, this is, again, subtle. People are paying attention to this and watching this. But in an actual full bull market, this is likely to go extremely deflationary, on a relative basis. So it's definitely something people will be watching and talking about nonstop during a full-blown bull market. Flipping gears to the technicals here, not too much changed week over week. For Bitcoin, we did have a bit of a breakout on low time frames. Nice high and tight bull flag, as it's called, potentially teeing up for another low time frame bull flag, ascending triangle, pennant type deal, whatever you want to consider that there. Ultimately, though, the two big resistance levels are the 200-week moving average and the yearly pivot at around 26.5. It's still got to contend with its own version of the diagonal resistance that the S&P has at around 23.5. So there's plenty of resistances on the way up in the near term. Would love to see this consolidate again over the next couple weeks, make some sort of convincing high time frame pattern, whether it be another pseudo inverted head and shoulders or some sort of deeper ascending triangle, something that can start the engines here as we get this 5,200 daily moving average cross, the first since the bearish cross really in early 2022. Now, you can look back just a few months before that to see, these crosses don't always play out amazingly every time, but it does help give credence to the expectation of higher highs over lower lows at the very least. So a bit of a congested picture there in the near term. And let's say magically we get above 26.5 in the near term. At that point, you're trading pivot to pivot. You're trading previous resistances somewhere around 30K. Not sure we have that type of excitement left in the near term, but also not going to rule it out. On the low time frames, though, this is what we're contending with, just a growing bearish divergence on RSI. Now, it's not multi-week, it's not multi-day. This is sort of intra-week divergence here, but it is suggesting that momentum obviously cooling off from basically at being at 100 to slightly down on the next high. So I would like this to reconsolidate somewhere between 21 and 22. Perfectly adequate. What you don't want to see if you're bullish is just complete retracement all the way back to 18 or lower. Plenty of volume support here all the way down to around 19. So that doesn't look super likely in the near term to me. What we do have to watch out for is this sort of triple top, shoulder head, shoulder to be drawn yet over the next 2 weeks. Very much an if this then that sort of situation as well, but something to watch for up and coming. Now, ETH has underperformed, switching just to ETH, has underperformed Bitcoin over the past couple weeks, which maybe isn't too surprising. A lot of the focus is on Bitcoin. But based on technicals, ETH looks like a cleaner trend breakout to me than Bitcoin here. Tons of lines here, right? Tons of just congestion that price is above. It's above the 200-day. It's above the 200-week. It's ready for a 5200 cross, and it's above the 2018 all-time high. Next stop for ETH, in my mind, is 2000. That's the yearly pivot. That's a nice psychological resistance level. Makes sense based on horizontals. That 2000 is the level to watch. What we may get is a support retest here, sort of confirming the trend at around 1400. Perfectly reasonable, but again, what you don't want to see is lower lows below 1100, below 1000, right? I don't really see rationale for that in the near term. But if you do see it, obviously that would buck the trend pretty well at that point. But as it stands here, it would not be surprising to me and in the slightest if throughout February, March, BTC and ETH do well, even regardless of macro. And into Q2, ETH starts to outperform BTC because of that supply soak and fee burn mechanism. It also has this multi-month Wyckoff accumulation fractal, which is named after Mr. Wyckoff, discovered it, first noted it on the S&P, I believe, in the early 1900s. But we've seen this frequently. This is, again, the Bitcoin comparison in 2015, which is probably the most textbook you're ever going to see. And the ETH schematic here doesn't match up one-to-one, but it is pretty close. And we may not see this perfect curve as we break out to 2000 plus, but as long as we don't make significant lower lows, I really like this chart above 2000. One thing, just like Bitcoin, what we don't want to do is make a triple top here. We made a similar triple top in this range before the FTX insolvency news, and that's not what you want to see if you expect higher highs, in the near term. And then lastly, just looking at sort of this macro picture again for ETH, multi-month, Adam and Eve. I try to be bearish, I try to be balanced, I try to look for both sides of the coin here. And no matter how you try to slice this here, it does look like this is trying to eventually make higher highs, certainly revisit 2K within the year, I'd imagine. And since the merge, since that proof of work to proof of stake transition, price has been flat percentage-wise. Certainly had FTX to contend with, but we really have not seen yet the effects of proof of stake, if they're to be positive at all. In Bitcoin's case, after having, typically we see some sort of outsized bullish effect up until a year after the event. So it's early still. This could take plenty of time. Certainly lots of people still watching inflation and macro, paying attention to how that affects risk, and digital assets are no exception. That's all for this one. This video is for informational purposes only, and the opinions expressed are not financial or investment advice. All opinions are my own and do not reflect the opinions of Valkyrie Investments and its affiliates. No fiduciary obligation or duty exists or is created between you and Valkyrie Investments or its affiliates, including me, by virtue of any opinions expressed in this video.